Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. If you're like me, you might have had a feeling of deja vu this week. You might remember that last week, markets opened down big on the back of some scary headlines, only to rebound as the week went on. This week, we pretty much saw exactly the same thing. The only difference is last week, it was all about DeepSeek. This week, it was all about tariffs. We're going to talk all about the ETF impact from everything that went down in markets this week, so you don't want to miss that. But after that, we're going to switch gears to discuss two new ETFs that offer private equity-like exposure through publicly traded stocks. This is a very hot part of the ETF industry that you'll really want to hear about. And finally, we're going to cover the latest ETF flows, launches, and closures for the month of January. A bunch of us at ETF.com chose our favorite fund launches of the year so far, which we're going to share with you. You absolutely do not want to miss that, so stick around. We're about to get started. Joining me today are my amazing colleagues, Research Lead Cantuni, Wealth Management Editor Jeff Benjamin, and Editor-in-Chief Kristen Myers. Kent, Jeff, Kristen, it's great to be on the pod with you all. How's it going?
Whoa, guys, we're the amazing colleagues. Who knew?
Yes, he says that every single week. I'm thinking he likes us.
No, last week it was fantastic, I think, Jeff.
Oh, okay. Well, to me, fantastic and amazing is the same.
Absolutely. So, guys, actually, Kent, I want to start with you because I know you've been following this extremely closely. Was it just me, or did it kind of feel like deja vu in the markets this week?
Absolutely. Yeah. I mean, I wouldn't call it a crash, but it was a pretty quick knee-jerk reaction, what a trader might call a catalyst. I mean, the prices were already high across the board, especially S&P 500 driven by technology. So it's almost like the musical chairs thing, just waiting for the music to stop and everyone's going to jump out. So the DeepSeek AI was kind of a scare, a shot across the bow, if you will, to semiconductor stocks. So you're seeing NVIDIA drop 17% in one day. This week, it was the tariffs on Canada and Mexico and China. The Mexican and Canadian tariffs were 25%. But if you're following the news, or people out there following the news, or we are, the tariffs were delayed by 30 days. Some agreements were made. And so on the ETF spectrum, the biggest move was EWW, the iShares Mexico ETF. From Friday afternoon, it had dropped 6% into Monday morning. But as soon as the news was announced that the tariffs were delayed, it went right back up to the same price that it was on Friday. So, mischief managed, problem solved for now or temporarily. But over the last year, that Mexican ETF is down about 27%. So it's still trouble. But yeah, that to me, that was the poster child of that Monday swing, and the broader market recovered as well. So everything's back to where it was 2 weeks ago, price wise. So we recovered.
Yeah. Were you guys surprised by the fact that even Monday, when we thought these tariffs are going into effect and they might stick with us, the S&P at worst was down 1.9%, and then it finished the day down only 0.76%. Does that surprise you, or is it just a matter of, people thinking these tariffs aren't going to last, a deal is going to be made?
I mean, that's the emotional question of the markets, right? Because we know the markets don't really like uncertainty, but we know that Trump is a president of uncertainty. And don't forget that we've already had him in the White House before, and we've also already had tariffs before, trade war going on with China. And remember that even in this rash of new tariffs, again, 25% against Canada and Mexico, 10% when it comes to Canadian energy imports, and an extra 10% on Chinese goods. We know exactly how the markets reacted last time. We survived, back when Trump was president. And so I think that what people are kind of expecting is that Trump is going to make proclamations. He's going to make these sort of trade deals. And then just as quick as he announces them, he walks them back, which is exactly what he did. I mean, we've had him now in office for less than 30 days. He's made a whole announcement of executive orders, and several of them have had to be walked back. And so I think you're going to see a lot of knee-jerk reaction around the headlines when it comes to President Trump and some of his policy initiatives. And I think just as quickly as you have that knee-jerk reaction, people, I think, are then going to kind of put their head up and say, wait, is this actually going to happen or is it not? And so I think what people are going to wait now is to see what actually happens in 30 days and if these tariffs go forward. And then if so, I think you're going to really start to see that ripple effect for industries like autos, right? Particularly when it comes to Canada. A lot of US automakers have parts that cross the Canadian border several times. So hitting a 25% tariff every single time a part crosses the border is going to be a huge problem for some of those automakers. You've got chips, energy is going to be impacted. Then, of course, the regular consumer goods and any sort of agriculture that when it comes in from Mexico. So I think knee-jerk reaction for right now. I don't, however, think that it's so much out of the woods just yet. I think in another, I guess now 28 days or so, I think we're going to probably see another reaction once, again, markets really have a firm sense of what's going to happen when it comes to tariffs.
Yeah. And I think you make a good point, Kristen. It hasn't been a huge surprise, right? No one really expected the 25% tariffs to go into effect. And, they really only went into effect for a couple hours. So that I don't think is unexpected. What I think also people are kind of encouraged by is the China tariffs of 10% are less than actually what Trump was saying on the campaign trail. He was saying 60% tariffs on China, yet so far only 10%. I guess, that's kind of encouraging if you don't want to see tariffs. But again, this is very early. This could just be the opening, salvo against China. I don't think the China trade war is close to being over by any means. And we also have to remember that Trump wants to make some other deals with China that aren't really economic. Things like ending the Ukraine war. He wants support from them on that. And he wants to see that TikTok sale go through, which might require the Chinese government to step in there. So, we'll see what happens. It's so early, and things are only going to probably get, more interesting on the tariff front.
I have a slightly different take on this, away from just Trump, because remember, this is the second consecutive Monday we opened with market volatility. Trump didn't have anything to do with the DeepSeek or artificial intelligence issue, but in both cases, these are things that kind of simmered over the weekend and came to a boiling point when the market opened on Monday morning. And then as cooler heads prevailed, more information came out, everything settled back. To me, this is an example of a market, looking at the S&P 500, that had facing back-to-back 25% gains. Things are looking frothy and expensive, and any and all catalysts are going to trigger things. They just happen to happen over the period of a weekend when most markets are not tradable. So this is what I'm thinking. Whether it's Trump or artificial intelligence or whatever the next thing is, I think this kind of volatility is just a result of where we are in the market cycle right now.
I think you're right. Yep.
Really? I hard disagree.
All right, bring it on, Kristen Meyer.
No, listen, I don't think you're totally wrong. I think that for a lot of reasons, markets are always looking for a reason to either pile in or flee from some of these trades. I do think that that's a good point and a worthy one to be made. However, I don't think that that's the only reason we see some of this volatility, and I don't think it's going to be the only reason we see volatility going forward. I mean, literally, we had 4 years of a Trump presidency, and they literally found out that every time he tweeted, he doesn't tweet as much anymore, right? But every time he tweeted, markets would take a hit to the downside by a quarter of a percentage point, I think was the average. I'd have to double look at some of those stats. But I mean, every time he tweeted, markets would react. And for 4 years, that cannot possibly be that, some things were just overbought and we wanted to just we needed to have that sort of volatility, and it was going to happen anyway. I think that he is a president that makes very knee-jerk policy sort of decisions. And I think that we then see that play out in the markets because they do have really major implications, not just for US GDP when it comes to some of these economic policies, but frankly, global trade. I mean, just the tariffs alone, that's a big deal. 25% tariffs is a huge deal, especially against our two biggest trading partners. And then if we're going to have retaliatory tariffs, and then increasing tariffs against China. I mean, these are huge policy decisions with huge, I would say, geopolitical and global economic implications if they do go into effect. The big question is if they go into effect, and I think that's the big problem. Markets don't know what the president is going to do because he frequently will come up with a policy plan and then back off that policy plan, or he'll pause that policy plan, or it'll go into effect, but not as badly as people were sort of expecting. I think that what we are used to is regularly being whipsawed around these things that could have, I think, really big impacts, not just here in the United States, but also abroad. I mean, we're talking about some companies here and some countries with massive amounts of consumer good companies that are going to be impacted, energy. I mean, I can't think of an industry that wouldn't at scale be.
All right, let me just jump in here. I'm not saying that Trump's actions were not a catalyst. I'm just saying that DeepSeek and artificial intelligence had nothing to do with Trump, and we saw similar results. I'm just saying any catalyst is likely to create this kind of activity. That's all I'm saying. I'm not saying Trump is not triggering some of this. I'm saying it doesn't necessarily have to be Trump to see this right now, see this kind of volatility.
Right. That's what I was saying too, Jeff. And I know I don't often agree with Jeff, so I kind of am here. I mean, the prices are already high. And so what Jeff's meaning by catalyst is that, anything could trigger a big sell-off because prices are so high that investors are waiting for the news to stop, so to speak. And my one comment on Trump is what I said last week: his bark is worse than his bite. So we're just going to see some volatility on that.
Well, don't let Trump hear you say that.
All right.
Trump listens to this podcast.
Now, I absolutely get both points of view. The market does climb a wall of worry. Every year we get negative headlines. They cause volatility. Usually those headlines don't cause, bear markets or anything like that. Sometimes they do, right? If something happens in the banking sector, like Silicon Valley Bank, it could lead to more drastic impacts on the economy. We'll see what happens with this. I understand Christian's point of view. It could be significant depending on what happens. I saw a couple of estimates. Some analysts at Citi were saying if the full tariffs on Canada and Mexico went through, the impact on S&P 500 earnings would be something like a 5% hit. So to me, that's definitely significant, but it's not necessarily catastrophic for the market. But who knows? There's a lot to grapple with here. We'll see what happens. Another thing I want to point out before we move on is I wrote a story earlier this week about how the two safe havens, or the two assets people consider safe havens, gold and Bitcoin, have performed a little bit differently this year in the face of these headlines that we're getting. GLD actually hit a record high this week, which kind of is what you would want to see if you're looking for a safe haven. That ETF's up 9%. On the other hand, IBIT, the Bitcoin ETF, sold off as we got these tariffs and on the DeepSeek news. But it's still up this year. It's up 4% year to date, but it hasn't been acting as much as a safe haven as gold has been acting. So that's something interesting to keep an eye on. Which one is the real safe haven? Everyone has their opinion on that, but we'll keep an eye on that. I think it's a good time to turn to the next segment. Very different here. This is about this whole new ETF, which offers private equity-like exposure through public stocks. Jeff, you wrote about this, these new ETFs. How do they work?
Yeah, this is interesting, and I doubt it was timed this way, but two ETF issuers this week issued ETFs or launched ETFs that provide, I call it proxy exposure to the private equity markets. First, you've got the Pacer PE/VC ETF, ticker is PEVC, Private Equity Venture Capital, that launched on February 5th. And on February 3rd, you've got the PEO Alpha Quest Thematic PE ETF. Sorry for all the P's and E's. Ticker on that is LQPE. Think of it as liquid private equity. What these ETF issuers are doing is private equity is usually restricted to high net worth and institutional investors. They've got high minimums. The fees can be in the neighborhood of 2% of assets under management and 20% performance fees. So big. Plus, they're not liquid. They're generally, I shouldn't say not liquid. They're less liquid. You can maybe make redemptions quarterly or something like that. So, but the performance is supposed to be generally non-correlated. It's supposed to be, on par with on a relative return with the broad equity markets of publicly traded companies. So what each of these ETF issuers are doing is they're using algorithms to create performance that is comparable to private equity indexes. And they're doing that by investing in publicly traded companies. Now, this is all back tested. I think in the case of AlphaQuest, they have there's a company that has done the actual performance for like a decade. So you're getting about 99% correlation to the private equity index for like 85 basis points, I think, which could be attractive to a lot of investors, especially at this point in the market cycle when, as we just talked about in the previous segment, when the equity markets are generally looking frothy. I mean, it kind of looks like an opportunity for retail class investors, as we call them, to gain some proxy-like exposure to the private equity markets. But as I talk to the issuers of these two ETFs, they see it as also an opportunity for traditional private equity investors, institutional investors, and high net worth investors to get the kind of private equity exposure that they had been or are looking for without going through all the headaches and higher expenses and less liquidity of traditional private equity.
It's interesting though, Jeff, because they're going to invest in public stocks, right? But my understanding of private equity is the private equity firms that go out and buy these private companies, and sometimes they even cut costs and have a say in the operations of the companies. It sounds like a completely different thing. In this case, they're just buying public companies. Obviously, they'll have no say in the operations. Sounds like a different animal to me, but
yeah. Let me clarify that. Private equity. If you're a private equity investor, all right, I'm not talking. If you're at the private equity firm level, yeah, you do go out and buy shares and generally, often majority stakes in private companies and turn them around or whatever you do with them. The investors in private equity are the people that buy into a fund of other private equity investments, and that's the performance that these ETFs are trying to replicate. Because they look at, let's say, I'm just going to throw this out there. Let's say over the past 10 years, the private equity indexes have averaged a 10% return. Well, in with whatever degrees of volatility and standard deviation. So these ETFs are going to replicate that performance by investing in publicly traded companies. So yeah, it's not the same thing at the actual company investment level, but it's supposed to be the same thing at the the fund investor level.
That makes sense. And there definitely seems to be this this rush to invest in private markets through ETFs. I know, what was it, in December we saw that Apollo ETF that was actually going to invest a portion of his portfolio in private credit. It wasn't a proxy. A portion was actually going to be in private credit. So I wonder if at some point we'll see an ETF that tries to actually invest in private equity directly.
I mean, the thing is that those two things they're kind of oil and water, because you've got the trademark of ETFs. One of the trademarks is liquidity and transparency and low fees, and those are all things that you don't get with private equity.
Definitely,
you got high fees. Liquidity is quarterly, transparency. Nobody's going to give up the secret sauce in a big fancy private equity firm.
Yeah, now it's very hard to pull that off in the ETF structure. Much easier in a closed-end, fund type of structure or something like that. But the demand for this type of stuff is just astronomical. So I'm sure, issuers are looking into whether they can pull this off or not. Imagine if, we had an ETF that had a stake in SpaceX, OpenAI, or some of those, really popular, venture type of companies. The demand would just be insane. But yeah, so hard to pull it off. So yeah, I think that's a good place to shift gears. The final thing I wanted us to talk about is, the flows, the launches, and the closures we've seen so far. I wrote a couple pieces on these topics. Let's talk about the flows first. January, very, very strong month for ETF inflows. $107 billion went into ETFs in the month of January. If you extrapolate that, that's effectively means we're on track for $1.2 trillion of inflows this year. You might recall last year was a record in terms of inflows, $1.1 trillion. So we're on pace to potentially surpass that, have another $1 trillion year. We'll see what happens with that. The ETF that stood out the most to me, we're going to be talking a lot about this in the coming weeks, is the Vanguard S&P 500 ETF. I mean, it's absolutely lapping the field so far this year. $21 billion of inflows. The second most inflows of any ETF is the Vanguard Total Stock Market ETF, $4 billion of inflows. So VOO has 5x the next ETF on the list. It's just running away with it. And this is happening at the same time that the Spider S&P 500 ETF, SPY, is seeing outflows. It's had outflows of like $14 billion this year. And that means that gap between the two ETFs continues to shrink, only $5 billion or so separating the two ETFs. Any day now, we could be talking about how VOO is the world's largest ETF. We'll see when that happens. Another ETF that stood out to me was JAAA. We've been talking about this ETF. Absolutely rocket ship in terms of demand. $3 billion of inflows this year. This is a $20 billion fund now. It just seems to be the hottest thing in the fixed income space right now. The Janus State Street Henderson AAA CLO ETF. This is mentioned the highest rated collateralized loan obligations. I think a lot of investors like this because it's relatively safe and it's also a floating rate instrument. So with a lot of uncertainty about whether interest rates will keep going up or whether they'll come down, this kind of removes the interest rate risk from the equation. So that was another popular ETF. Check out the article we have on the site about ETF inflows for January if you want to see more some of the other ETFs that were on the list. But also, I want to talk about the ETF launches and closures for January. There were 73 ETFs that launched in January, 14 closures. That means that just like flows, we're on track for a record year when it comes to ETF launches. We'll see if this pace keeps up. But for now, issuers are just, throwing stuff out there and seeing what sticks. So, Kent, Jeff, I want to turn to you guys. I asked before this podcast whether you guys had a favorite ETF launch of the year, or at least one that stands out to you. So why don't we start with you, Ken? What ETF launch of 2025 so far has stood out to you?
Well, I anticipated that perhaps you and Jeff might find something that's somewhat maybe left of center, kind of complex. I went the opposite route and chose a launch that was February 5th, just Wednesday, the Schwab Core Bond ETF, SCCR. And I chose that just because, here we have a giant issuer and also this year, and it's an actively managed intermediate bond ETF. A lot of these bond ETFs that call themselves a core ETF, typically broadly diversified, and it's actively managed. It reminds me of the Fidelity Total Bond ETF, FBND, which what they're going to do is they're going to just go across to the board on credit quality and duration, but the average duration is around 6 years. So that's right in the intermediate spot. It's a sweet spot, if you will, too, for this year, because you have some people taking some risk and thinking maybe yields will fall. That's a big risk. You see funds like TLT did that last year and the year before. And then you have some investors wanting to go the ultra short-term route and get, a decent yield, but low interest rate risk. These type of funds like SCCR, Schwab's new core bond portfolio, right there in the middle. So if you just want to just park some money in bonds for whatever reason it is, diversification, or you're trying to play some interest rate risk, and you want to get some price move upward, but don't want to take too much risk, that's a good place to be. So that's SCCR, just launched on Wednesday.
16 basis point expense ratio, it looks like, on that fund, Kent, so pretty low as well. Yeah, that's a good one there. We'll keep an eye on that. Jeff, what did you come up with?
I also picked a fund, or actually two ETFs that launched on Wednesday, February 5th. They are, now brace yourself, because this is not going to be the most exhilarating kind of pitch ever, but these are two ETFs from BlackRock that are wrapping traditional money markets, what would be a money market mutual fund, into ETFs. What's interesting about this is that they follow this Rule 2A7, a provision of the Investment Company Act of 1940 that is traditionally reserved for money market mutual funds. BlackRock, like everyone else out there, sees all the money sitting in cash right now, like $6.8 trillion or something like that. And what they did was they came out with the iShares Prime Money Market ETF, ticker PMMF, which invest in prime money market beyond just government debt. And then there are the iShares Government Money Market ETF, GMMF. Now, the GMMF, that follows by a few months the September launch of the Texas Capital Government Money Market ETF, ticker MMK. That was the Texas Capital Bank Private Wealth Advisors. That is the company that launched the first of these money market funds inside an ETF wrapper. Now, the Texas Capital version was launched in September. It's gotten a little over $50 million. What is going to happen, I'm suspecting, is that BlackRock, being BlackRock, the world's largest asset manager, and with all the sway and girth of anything that you might imagine of that kind of size, they will draw attention to this, and you'll see money going into these things. Maybe Texas Capital will benefit from, in the wake kind of thing. But either way, it's going to be an opportunity to get yourself some money market exposure and security inside an ETF for, I can't say for the first time, but I can say for the second time.
So Jeff, it's my understanding that from an investor perspective, these money market funds are going to essentially act the same way as those ultra short-term bond ETFs that we already have on the market. They're still going to hold treasury bills, and the returns are going to be pretty much the same. I think the only difference is the money market have to abide by certain rules, and those rules are a little more strict than the ultra short-term bond ETFs.
Exactly.
Okay.
That is the distinction. That's why I reference that. I don't want to sound too much like a wonky nerd here, but that's why I reference that Rule 2A7 of the Investment Company Act, because they follow the same rules of a money market fund. So they are, you could argue that ultra short bond ETFs are comparable in terms of performance, but not in terms of investment security. That's what you're getting. You're I think you're literally getting a money market fund wrapped inside an ETF for, like I said, the second time, because Texas Capital started it. But theirs was strictly a government debt. This the BlackRock has the government debt one, and they also have the prime one, which goes beyond just government debt.
Gotcha. Okay, cool. So the ETF I want to highlight, we've talked about this on the podcast before. It's those Calamos Bitcoin Buffer ETF. CBOJ is the one I wrote about earlier this week. It's essentially a Bitcoin ETF, which gives you exposure to 12% upside, but you're 100% protected on the downside. They also have two other ETFs. One gives you 29% upside, 90% downside protection, and then there's another one which gives you 50% upside potential and 80% downside protection. So these are interesting because, we always talk about buffer ETFs, and the most popular ones obviously track things like the S&P 500. This is a buffer ETF in the crypto space. So it's giving you more upside potential. But obviously, you have that downside potential as well because Bitcoin is probably going to go down more than the stock market when things go down. So that's kind of the trade-off you have here. But I think that there's a place for this. We could see, when you're talking about an ETF that could give you 50% upside, but only 20% downside over a year, I think that could be compelling for some investors. Especially once Bitcoin sells off, people are looking to go bargain hunting in that space. You might not want to just buy Bitcoin outright because there's a potential Bitcoin could drop another 30, 40, 50%. It's just that type of asset. So if you could buy it, potentially play it for a bounce up 50%, but then be protected if it does keep dropping, I think that could be compelling for some investors. I don't know. Jeff, you're kind of skeptical about these, I know.
Yes. I'm skeptical about this strategy in particular because I look at it as like if you're investing in Bitcoin or crypto in general, you're investing in an extremely volatile asset class. And there are pros and cons that don't even need to be restated that come with investing in this kind of volatility. If you're going to put this inside the tight band of 10 or 20 percentage points, my question is, what's the point? And I've talked to some of the issuers, the folks at Calamos, and they're saying, well, this is for financial advisors whose clients want to be exposed to crypto, but they don't want the volatility. I don't understand that. That's like saying I want to go to a football game, but I don't like violence or something. It's if you're going to be investing in crypto, volatility is part of the game. Like it or leave it. But if you're only comfortable with a 10 or 20% band of upside and downside, then you should be just investing in, I don't know what, maybe treasury bonds or not treasury bonds.
I absolutely agree with you, Jeff, especially from an investment perspective. If you're buying Bitcoin for the long term, you expect it to go up 2x, 3x, whatever. This is not going to help you with that because you're giving up a lot of your upside potential. But I think as a trading tool, maybe, some people might find it interesting. Like you have an ETF that could give you 30% upside, but only 10% downside. A trader might find that interesting, right? They think Bitcoin's going to bounce over the next 3 months. But just in case it doesn't, they want that protection. So maybe that it makes sense.
I understand. Yeah, the trading vehicle component also works, but remember, these are defined outcome strategies. So they generally have to be held for the duration in order to get the full benefits of the downside protection and the upside cap. I just, I know that these things will sell like hotcakes because it's got the buffer and they don't call it boomer candy for nothing. But my question is, if you're a financial advisor or even if you're an investor, why are you doing this? If you don't like volatility, don't go anywhere near crypto. And if you want volatility, if you want crypto, real crypto, I would avoid these things, the buffer around it. But like I said, there's a market for it. They'll sell for sure.
Fair point. So, I think that the last thing I just want to mention, I talked about, I wrote that a launches story. In that same story, I talked about closures. We had a little over a dozen ETF closures for the month of January. The two that stood out to me were MJUS, which is a cannabis ETF, an Amplify US Alternative Harvest cannabis ETF. They shut that down. Amplify still has another cannabis ETF on the market today with the ticker symbol MJ. so that they're not completely out of that industry. The other one that stood out was the iShares Frontier and Select Alert Emerging Markets ETF, ticker symbol FM. That actually had almost $200 million in assets at the day of its closure. But, BlackRock came out. They said last year that the reason they're closing this ETF is because of liquidity issues. Frontier markets, some of you may know, are, very illiquid markets, some of the smallest countries in the world. So apparently BlackRock, it just wasn't practical to keep this fund running just because of the structure of those securities. So they shut this down. This used to be as big as a $730 million fund at its peak. Now there is no way really for investors to easily get access to frontier markets in the ETF wrapper. We'll keep an eye on that. But yeah, I think that's a great place to wrap it up. I want to thank all our listeners for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.